Monetary policy is how the central bank makes changes in the economy to help achieve economic goals.
People would always want money because there are two kinds of demand for money. The first is the asset demand for money, which is the demand to have money as an asset or a savings. The second kind is the transaction demand, where people will desire money to be able to purchase goods and services.
It does this by managing three main aspects. The central bank dictates how much money will be printed, how high or low interest rates will be, and how much government bonds will they buy and sell.
When the central bank decides to print more money, that increases the money supply, and the increased money supply gives the banks more money to loan out, ultimately increasing the demand for money in the economy. The opposite happens when the central bank decides to print less money, the demand for money is decreased instead. On top of this, given the law of supply, a high money supply would cause a surplus, and the different commercial banks would compete by lowering interest rates to attract more customers. On the other hand, a shortage will increase interest rates as the interest rates would adjust to an equilibrium quantity with the money demand.
The central bank doesn't actually directly change the interest rates. The central bank manages something called the discount rate. Commercial banks that we see on streets and malls actually borrow money from the central bank and have to pay the money back with additional costs from the discount rate. Hence, to be able to pay off the discount rate, commercial banks will have to adjust their interest rates in direct proportion to the discount rates.
As the central bank changes the interest rates, this affects the demand for money because by nature, people will want to borrow money when they have to pay back less. Hence, low interest rates attract more people to borrow money, while high interest rates would be more unappealing for people who are looking to borrow money.
There are two kinds of monetary policies, the expansionary monetary policy and the contractionary monetary policy. The expansionary monetary policy is used by the central bank when the country is facing a recession. This implies that the GDP has been constantly shrinking, hence hindering economic growth. When the central bank conducts the expansionary monetary policy, it increases the money supply, lowers interest rates, and sells privately owned government bonds. A higher demand and supply for the money will cause more transactions, which will increase the overall GDP and help economic growth. The contractionary monetary policy is the exact opposite. The central bank uses this when the economy is progressing too quickly. If the economy is growing too quickly, not only do all prices skyrocket to absurd digits, but living standards in the country simply become too expensive, not to mention all the pollution being produced that harms the environment. Hence, to keep all these in balance, the central bank will dictate lower money supply and higher interest rates to lower the demand and supply for money. Have the exact opposite effect of the expansionary monetary policy. There will be less transactions made, and less transactions will cause a deflation, which will help people keep up with the prices.
The main goals of monetary policy is to prevent inflation rates from spiraling out of control since the demand of money directly affects inflation rates. It also provides employment opportunities for the community through having a proper balance in funding businesses and the government. A good balance of both helps the economy in overall economic growth.